So welcome everybody to week 7, and the first week Wayne did tell us this would be a long time, and it's probably going to be longer than we originally thought. Jay Powell, the chair of the Federal Reserve, said the virus will decide the time frame, and there's still so many unknowns when it comes to this virus. But Wayne, at the end of the day, the week was flat in terms of the stock market, but it was an exciting week. How did you see it?
Well, we finished a great month. It was the best month since 1987. And that's really, I think, a function of all the money that's being printed. I just checked before we came on, the year-over-year growth in money supply is around 25%. That's way more than back in 2008, 2009. It was 20% a week ago. It's just climbing. They're just opening the floodgates. They're hammering. They're buying corporate bonds, ETFs, everything. And the VIX broke below 40. Hit almost 30, bounced over the past couple of days, but
no, wait a second. I'm going to just explain what the VIX is there, Wayne.
It's the volatility index. It's basically it's a measure of what risk is worth.
So it's great when it goes down because it shows risk is coming out.
So it shows you that basically things are settling down. We hit almost 30. We hit, I think, a high of 85 back in March. So that's a good sign. And this week we saw some signs within the internals of the market where people started coming in and buying value stocks. And they had a bit of a run up until the past couple of days. And when the past couple of days, the numbers weren't that good on Thursday. In terms of the unemployment numbers weren't that strong. And then Amazon did great. Their revenues beat quite dramatically, but their earnings, they're spending more money hiring people, et cetera, and building infrastructure. So the earnings were a bit of a miss. But so far, so good. But I think to go further, we've had a nice rally here off the bottom. Cyclical stocks, the banks, industrials, oils, or energy stocks to come back, and maybe smaller caps. And we had a bit of a small cap bounce early on in the week and came off the past couple of days. But to go further, we need those kind of stocks to do well. All the heavy lifting to where we are today has really been by the technology space and the healthcare space.
Yeah, I was going to just mention, maybe people know this, but the 5 largest stocks on the S&P 500 of 500 stocks represent 20% of the value. And this was happening in 2019, even 2018, that the leadership is getting narrower and narrower. And this is accelerated through this virus. What will the catalyst be? I guess it's going to be growth and get over this virus.
Well, I think when we have clear signs that we're over the bottom. I think right now the market is saying, hey, we can see a bottom here. We can see economic activity picking up. They actually track economic activity by looking at mobile phone activity for people walking or driving. And it's off the bottom, it's going up, and it's going to get better. So that's a good sign. So the market wants to see a bottom. It's seeing a bottom, but it isn't clear yet what the new world is going to look like. And will there be a second wave? But whenever that conviction comes, and we saw a bit of it this week, you're going to see people pile up the small cap stocks, the beat up stocks, the cyclical stocks, and they'll leave the big guys behind. In fact, this week, the bigger stocks did lag for most of the week.
Certainly, it seems to me investors want to believe, but every once in a while they get reality strikes and they can't do it. Now, today the market was down quite a bit, and there's more talk of, again, tariffs were in the world before this, and there talk of more tariffs to China. I don't want to talk too much about the tariffs because they may or may not, new tariffs, they may or may not happen, but more than a year ago in our quarterly videos, you talked about how crazy it is that these big companies have supply chains all locked up in China and that they're going to have to diversify. I mean, that's a year old. That's nothing to do with the virus, but this virus has sure highlighted that some more. So tell us what we can glean from this new supply chain. What does it mean longer term?
Well, number one, corporations have to get their supply chains diversified. Too much exposures to one vendor like China is going to cause you a problem. When you get a pandemic or there's a trade war, right? It's going to hurt you. And so I think that was the message during the trade war: get your supply chains diversified, get your vendors. It's just simple, good business.
Longer term, that does mean the world's less efficient and corporations are less profitable.
Well, this is about managing risk. If you want to just maximize profit.
No, but it does mean less profit too.
But I think longer term, it's going to be better for the rest of the world in terms of what's going on with China. Like China's going to has an issue. The Communist Party there is an issue. It's going to become, I don't think Trump's going to do anything prior to next election, but it's going to become a hot election item. And that's what's getting the market a bit spooked. And that came out today. And so the semis got hit, for example, the semiconductor stocks got hit today because they have a lot of exposure to China. So it's going to be an issue. You know it's coming. You can see the Trump moving towards laying the blame at China's feet. It's going to be a big issue. So it's going to probably cause some days of volatility. But I don't expect him to do anything silly until he'll do other silly things. But in terms of putting a tariff in place, prior to the election, but I could be wrong.
So what about poor old Canada? Are we going to actually get back in the manufacturing business to have our own supply chain?
Well, it looks that way. They've been kind of slow on some of the antibody test and some, these kinds of things. Rather than using international supply, but we have to put people to work somewhere, I guess. And the energy space is going to be hurt, I think, longer term. We need some. I'm still waiting for an industrial policy of some kind that we have here beyond oil, and that hasn't been forthcoming over the past 10 years. And so we need something new, I think, to invigorate the economy, and maybe it's a new industrial policy of some kind.
So we need to challenge the political parties for better policies. Now, just to shift gears for a second, this call is all about the theme of these things were all in place before the virus, but they're accelerating. And so there's 3 technologies that have been in place for a long time, but again, they're accelerating. That's 3D printers, that's robotics, and it's blockchain. I don't really want to go into all 3 of them, but I'm curious, do we have exposure in our clients' portfolios for the success of those technologies?
No, not right now. Not a lot of exposure there. Our exposure is primarily in the cloud, stocks like Microsoft and Amazon, and then a lot of the chips and 5G exposure. Everybody's using more computers now, and we're excelling into 5G. We need more and more chips and the Internet of Everything. So I think those other themes are strong themes longer term. But right now, the biggest, deepest themes are the cloud and chips, and getting ready for the 5G kind of world where everything will be connected to the Internet.
Well, and the other thing about these 3 new technologies is you don't have to invest in the technology. You just need to invest in the companies that are using those technologies, because they will make the companies who use those technologies much less risky and obviously much more profitable. And unfortunately, maybe employing less people too. Anyways, I just wanted to ask you that. Now, we've got a few questions from last week. People are intrigued with the bond market vigilantes. And how in the world do they stop, all this money getting printed?
Yeah.
Really, inflation's going to come roaring back. And you said, no. Well, maybe. Well, you said, who knows? But the bond vigilantes will help, or it might stop that. So please explain.
Well, let's go back to the bond vigilantes. The bond vigilantes were the bond investors that were concerned about inflation back in the 70s. And we had Bretton Woods in 72, which really caused a lot of inflation and monetization. And so what the bond vigilantes did, they said, okay, we want to have inflation, which is right now 2%, plus 7%. So, so that if that was the case today, if they came back and wanted 7 or 5% above inflation, we'd have bond rates up around 7 or 9%. That would just kill the economy. So, if you want to have runaway inflation, you first have to destroy your bond market. And in smaller countries like Argentina they've had to blow out their bond market, but it's different when you're the #1 lending market in the world. And if you try and destroy the bond market, rates will go so high, they'll choke everything else off and kill everything else. If we had 7% real interest rates here, that'd be 9%, it would kill the stock market, kill everything else. So that's the fine line. The question is, well, and so far for the past 40 years, the bond vigilantes have been sleeping. They have not been home. And we don't want them to come back. And actually, President Obama, he was concerned about them. And he said, we don't want these guys to come out. Just keep them in their hidey hole and keep them asleep. And when they come out and then they get a whiff of inflation coming, bond investors will ask more of a premium over inflation. And that itself could choke the economy off, because the economy is so levered and so much in debt right now. So it's a fine line. So it's not a fait accompli. We're going to get runaway inflation by all this printing. The bond vigilantes may come out and crush a lot of financial assets. So that's the fine line there.
It is a fait accompli that it's a more risky environment.
Yeah.
That's the way. Now, one last question, emerging markets, any quick comments about their stock market and their bond market?
Stock market, we still think there's going to be issues right now, probably in South America, with a lot of exposure to commodities, and there's a lot of exposure there, obviously in Russia and those kind of places. And still, China's going to have more issues here with trade issues, also with their exposure to the global economy. They're still being impacted. So I think it's a bit early. Our models are neutral to kind of negative. So we want to see what happens there. But I still think that you stick to the big and the developed markets, and the U.S. in particular.
And the bond market, emerging market bond market?
That's going to be tied to our bond rates, and so I don't see any issues there in terms of getting any worse.
Okay.
As long as the U.S. dollar doesn't go too strong, and I think they're going to try and keep the U.S. dollar. So it's a function. Emerging market debt's more tied to U.S. dollar, and
So I think we got that. So we want to keep these short and hopefully informed. Thank you so much for your questions. Most of the questions I asked today were from clients. I've stuck one of mine in there. So I'd just like to end with a personal feeling that I think people in our community are kinder than they were before this. And I think that's something that's also accelerating through this. And that's something we all are participating in. And so we wish you lots of kindness, and we appreciate your sentiments. You guys have been great. We get lots of feedback from you, which we really do like. And again, if you do not be silent, if you have questions, call your portfolio manager, send in your questions. We're here to serve. So thank you very much. And I think we'll see you next week.
Thank you.